Hey, what's up? This is Greg, and this is your market update. All right, so today the government announced that inflation as measured by the CPI came in at 8.5%. This is compared to 9.1% last month on an annualized basis. So the CPI increase backed off a little bit. The expectation was around 8.7%. Core CPI came in at 5.9%, which was roughly in line with what happened last month. So as far as the core rate goes, which backs out fuel and food, again, for those that don't eat or heat your house or drive a car, inflation is still going full bore at 5.9%. Okay, now what does all this mean? All right, well, one thing that happened was the market's reaction was that the market rallied. Okay, the Dow was up over 500 points, the NASDAQ was up 359, and the S&P was up 86. So the market rallied. Of course, this was just a knee-jerk reaction to people theorizing and thinking that,
oh boy, the inflation has peaked. Oh, the Fed's going to start easing soon.
you know, it's this ridiculous emotional sort of rose-colored glasses, wishful thinking attitude that the market has, that any glimpse that inflation is moderating, you know, they think that everything has peaked and the Fed's going to start easing again eventually, or at least backing off, and this is bullish for stocks. Okay, in my mind, very short-sighted. I've said many times, do not pay any attention to daily movements in the market. It means absolutely nothing. It's purely emotional, and these reactions are frequently wrong, and they mean absolutely nothing, people. All right, but what does this really mean? I mean, to me, the 8.5%, if you boil it all down and cut through all the BS, basically it shows that gasoline prices have gone down for 50 consecutive days, basically, more or less. Okay, there've been 50 basically consecutive reductions in gasoline prices. So that's primarily the difference between the 9.1 and the 8.5. And why has this happened? This has happened, plain and simple, due to demand destruction. People have been driving less because the prices are so high. They can't afford it, so they're changing their behavior based on extremely record high gas prices. Okay, it doesn't mean anything more than that. And in a way, the Fed is accomplishing what it's trying to accomplish with raising interest rates and tightening credit, but meaning that it's causing the economy to slow down. But in terms of this number, most of the reduction in this number came from reduction in gas prices. So it really doesn't mean anything. It doesn't mean inflation has peaked necessarily. But even if inflation starts going down, all it means is that the Fed is accomplishing what it's trying to do, which is basically slow down the economy, slow down the demand side, which is really all it can do. And so eventually, if they keep raising rates and tightening credit and quantitative tightening, which is reducing the balance sheet of securities, eventually the economy is going to soften and inflation is going to go down. I mean, it's just math, right? So the question is, when is that going to happen? Now, meanwhile, all of this is happening against the backdrop of disappointing earnings, okay? And I've been predicting this for about 6 months on this channel, that this rise in interest rates and the rise in inflation will eventually cause problems for most corporations, and that's exactly what has been happening. Okay, in the last couple of weeks, Meta announced disappointing earnings. Nvidia in the chip sector cites weakening demand. You've seen basically across the board, tech, travel, retail, and of course housing, you're seeing softness, all right? And housing in particular, you're seeing softening demand and prices going down because of the rise in interest rates, right? It just makes sense. So a lot of the froth that we've seen post-COVID in the housing market is getting, is moderating, softening, etc. And you're seeing that quite distinctly in the housing market. So you're seeing demand destruction because of the inflation in many industries. The lowering of gas prices is probably the best example of that. The core is showing no reduction in inflation, which means that the core inflationary items minus food and fuel are still very tight. And don't forget, we had last week a very explosive jobs report. So there's still enormous price inflation on the job front, and that is contributing to the overall inflationary situation. I believe that the country is in a mild recession right now as a result of the rising interest rates and, most importantly, the inflation that we're seeing. I would expect this to continue, and probably as these factors continue to affect the economy, I would expect to see further softening in the economy, which can be viewed positively in the market because the market applauds anything that indicates that the Fed might slow down in its tightening and interest raising. And many people, I think, very foolishly expect that the Fed's going to pivot and start easing again, which I think is ridiculous, and I would not expect that. Companies across the board are experiencing demand destruction and also margin destruction as their sales soften and their costs go up. This is just a natural consequence of such a high inflationary environment, and I'm seeing that that's going to continue. In terms of where this leaves us from an investment standpoint, I think the basic theories I have for where to put your money in this kind of an environment has not changed. I'm still very bullish on the energy sector, and I've done a tremendous amount of content on this channel related to the energy sector. I'll put the playlist up here of some of the recent videos I've done that talk about all of the reasons in the international market why I believe that energy is still a very bullish place to invest. Of course, Exxon, Chevron, and Occidental Petroleum are my top picks, basically the integrated oil companies in that sector. And we've been playing that for a very long time here on this channel with a very great amount of success. I'm also bullish on the mega cap high-tech growth stocks, and my top pick on that is Alphabet, which I recommended pre-split, and on my position I'm up about 10% so far. I bought 2 tranches pre-split, and now we're seeing around a 10% increase in where I went in on that, and I did videos on that. I did a video on that which you can see in the description. And the other thing that I'm saying, so those are really the 2 areas that I would focus on. You got to be a stock picker in this environment because I believe that we're going to see continued volatility going into the fall. And I think a lot of these issues that investors are looking at with rose-colored glasses, meaning the inflation situation, the economic situation, and the earnings situation, will come into full focus in the September-October timeframe, as they typically do seasonally. And I think once everybody gets back from the Hamptons and wherever else they are, Nantucket, wherever they are, once they begin to focus on what's actually going on here and the degree to which the economy is softening and some of these companies are taking hits, not only to their earnings but to their growth rates, I expect to see earnings revisions going down, and there will be further sell-offs in the market, and I believe we'll hit new lows before eventually there's capitulation and the market eventually starts to go up again, monitoring Fed policy, and that would have to occur in conjunction with the Fed beginning to ease again, because you can't have a bull market when the Fed is tightening and increasing interest rates. All right, well, I hope this update was helpful. If you got value out of this, please like and subscribe, and I hope to have you on board for the next videos that will be coming along very soon, where we talk about specific stock recommendations and investments. We talk about the economy, we talk about Fed policy, we talk about economics, we talk about all the things that will make you a better, more informed investor, and hopefully a richer investor. Okay, well, thanks for watching. This is Greg at DLA Markets, and I look forward to seeing you on the next video.